So in this video, we're going to look at an actual commercial real estate deal and recalculate some of these metrics that we talked about in this module that are related to commercial real estate mortgage financing. So this is an apartment deal in Texas. So it's a 318 unit apartment building. The purchase price is $60 million. And so this is what's called a offering memorandum. It's basically a presentation that is going to go through a lot of the details of this deal, and it's meant to basically inform potential investors as to what the deal is, what the financials look like, and what you could expect in terms of returns and what the business model is, what the business plan is. And so we're going to not go through the whole thing. We're just going to look at kind of the financials. But, this presentation is going to be something that you, if you become a real estate professional, you may end up making to attract investors. Or if you are an investor, you're going to be reading through these to basically scrutinize a deal and decide whether you want to invest or not. Okay, so on this page, we're given a lot of relevant information that we're going to kind of analyze a little more deeply. So we have the purchase price here, $60 million. And then we have some other metrics that are kind of useful to just understand the valuation of the property, if this is a good price or not, because this is basically the deal, or sorry, this is the price that this particular, what's called a sponsor, has negotiated to buy this property. So you now, as an investor, need to determine, is this a good price? Has this sponsor done a good job of negotiating? Is it a price that I'd feel happy to invest my money in? Okay, so it's giving you the number of units, the price per unit. So this is basically the total price divided by the number of units. It's giving you a price per square foot. So these are important metrics in valuation. Okay, so you may know the Texas market well and realize, hey, 188,000 a unit is actually a pretty good deal for the market right now, or it may not be. So that's why kind of these metrics are there. It's giving you the net operating income. We're going to look at this more deeply, how this number came about, but it's just kind of listing it for you here in basically the summary page here, and it's telling you what the income is and the expenses. We're going to drill down a little deeper into these income and expense numbers and see how they calculated this operating income. And then let's look at the loan terms. Okay, so this is going to be kind of the focus of this video here, is doing some of the calculations around the loan. So you can see that the total purchase price is 60 million. And the debt that they're proposing, this is the kind of the terms of the loan that they've shopped around to different lenders, and this is the loan that they're proposing to put on the property when they buy it. Okay, so they're gonna finance this $60 million. Of that, 45,250,000 is gonna be from the raising of basically a mortgage. Okay, they're gonna go to a lender and borrow that. And then the remainder is going to be equity. This is going to be from owners. This is from the investors, right? So this presentation is meant to solicit investors that are going to contribute to this $24 million that this company needs to raise to basically buy this property. You'll notice one thing, that if you add these two together, you can already see that it's going to be over 60 million. 45 plus 24 is around 69 million. Okay, so what is accounting for that difference? Let's look at that in a second, because there's some additional stuff. But in terms of the loan, let's just kind of continue looking at some of the other factors of the loan here. So you see the interest rate. So it's SOFR plus 2.7%. So we discussed what this means in a previous video. SOFR is the benchmark interest rate. It's the basically the overnight lending rate for banks to borrow from the Fed. It's the risk-free rate. And then there's a spread over that of 2.7%. So that is compensating for the riskiness of this particular deal. Okay, so the bank is gonna basically be changing the interest rate over time. This is going to be a variable interest rate loan, and SOFR is going to change over time. If you looked at SOFR in 2022, it was probably close to less than 1%. Now it's probably 4% or something. So that SOFR rate changes a lot, and so so is the interest rate of this loan, because it's going to be that SOFR plus the spread is the interest rate that you as the borrower are going to pay. And now we see two different metrics here that look similar. We've heard about loan to value, 75.4%, and loan to cost. LTC stands for loan to cost. So uh, in a second, we'll go through and calculate these numbers, see how they got them. But let's just remember those two terms. Loan to value we kind of are familiar with, and loan to cost is a new one, but it's related, it's similar, and we'll see what the difference is in a second. The term. Okay, so uh, 3 plus 1 plus 1. Why couldn't they just write 5? Because 3 plus 1 plus 1 is 5. What this is saying is that it's a 3-year loan, and then there's two 1-year extensions. Okay, so that's what this notation means. It means that for the loan is just 3 years when it first starts, and then you as the borrower can pay a little extra to extend the loan to a 4th year, and then if you want, you can also pay extra and extend it to a 5th year, but you don't have to. You could just pay off the loan in 3 years. Okay, so that's what 3 plus 1 plus 1 means. It means that it's a 3-year loan and there's two 1-year extensions. Amortization 30, that means that the amortization schedule is based on the loan being 30 years. So there is some principal pay down, but it's not going to be that much, because the principal amounts that are being paid is assuming the loan is 30 years, when in actuality, it's only really a 3-year loan um, with these options. So you're borrowing 45 million. You're not going to owe 45 million at the end of the term of the loan, but it's still going to be something. It's going to be 40 million because you've paid some off. So you've kind of paid off some principal, but basically not everything, because to pay off the entire 45 million in 3 years, it would the property would not generate enough cash flow to do that. So the lender is like, okay, we're not going to make it interest only. We're going to have some amortization, but we'll give you a 30-year kind of schedule for paying off the principal. We're not going to go through all the details. We'll save that for when we are in the module on commercial real estate, where we'll spend more time going through kind of more detail here. So let's just look at one more thing. So this number is going to be useful for calculating our loan to value and loan to cost. So you can see here, there is this sources and uses section. So this is showing what the money is going to be used for that's going to be raised, and what the sources are. Okay, so you can see that to buy the property, it's going to be 60 million. Closing costs are all the fees related to the purchase. So this is like, you have to pay the lender a fee up front. You have to pay for escrow. You have to pay for inspections. There's a bunch of different costs that are associated with just kind of buying the property, and that's $835,000. The acquisition fee. So this is a fee that this sponsor is going to charge the investors, essentially, for putting kind of the deal together and like acquiring this property. They're going to charge. They're going to make a fee. The company that's kind of proposing this deal. The Okay, so the closing costs are separate. This is probably just inspections and any kinds of escrow. It's going to be mostly probably inspections. Okay, that's what I suspect, in reports. The lender fee is going to be paid to the mortgage, to the bank, essentially, for kind of arranging that $42 million loan. Interest rate cap. Okay, so we talked about basically the interest rate swap. This is An interest rate cap is a similar product, in that it's gonna basically only become a swap past a certain point in the interest rate. So it's gonna basically protect you as the borrower uh, on the floating rate once interest rise to a certain point. Okay, so you're paying kind of for this insurance. It's essentially interest rate insurance. Okay, so that's going to be a cost here. Now this big line item, 6.2 million. capital improvements. So we talked about rehab, right? This capital improvement budget is going to be to fix up some of the units. Maybe they want to paint the outside. Maybe they want to put in a gym. You'd have to read the entire business plan to see what they're going to do with this 6.2 million. But this is essentially a rehab budget. Okay, this is to improve the property. And then working capital. This is just to have some cash on hand to pay for expenses as you're collecting rents. As you know, expenses go out, there might be some cash you just want to have in your account to buffer that. And so you have your total uses across all these things is 69,475,000. And then your sources are again the mortgage that you're going to be borrowing, and then investor equity. This is money that you're going to raise from people to invest in this deal. Okay, so just in Excel, I've copied some of the amounts from the presentation here, just so we can do the loan to value calculation and the loan to cost calculation. Okay, so loan to value is going to be the simple one that we talked about, where we take basically the loan principal divided by the purchase price. Sorry, and I actually made a typo here. It's actually 60 million. Okay, so if we convert this to a percentage here by clicking on the percentage here, 75.4%. So let's go just verify that in the presentation. Okay, so you can see here 75.4. So that's how they got this loan to value. Now, loan to cost is going to actually be the total cost, including that rehab budget. And so what it's going to be is the numerator is the same. It's the amount of the loan. But now we're going to take the full budget, not just the purchase price. We're going to include all those costs that we talked about, the lender fee, the closing costs, and most significantly, the rehab budget, okay, and see what that percentage is. And just like a little Excel tip, what I did here is you put an equal sign that kind of opens up Excel to know you're calculating a formula, and then I just use cell references. I reference the blue cell F7 divided by this red cell F6, 65.1. So let's verify that that's what it says in the presentation. And yes, we see the loan to cost is 65.6. So that's where these numbers are coming from. Okay, so now let's talk about NOI and DSCR. Okay, so this is the operating budget. Okay, so this is a profit and loss statement, and it's a pro forma. Okay, so you can see year one, year two, year three. Uh, you can see this and kind of, if you've looked at enough of these, you kind of realize they're saying basically in the first year, second year, and third year after owning this property, this is what the pro forma operating budget is going to look like, or rather, this is what we expect to happen, and this is what we expect the profit and loss statement to look like. So let's walk through these different items here. So the gross scheduled rents. So there's like 318 units, I think. So they have some idea of what they can rent those units out for. And what they did here is they assumed we're going to rent all of them out at the rents that we're expecting to get, and we're going to assume 100% occupancy. Okay. So this is the total amount that they could get in the best case scenario, assuming they get the rental rate that they expect to get. Okay. And then they're going to subtract out some amount for vacancy because they're not going to be 100% occupied. Okay. There's some assumption here that there's going to be tenant turnover. There's going to be some months where, they're not going to have all the units filled up. So they subtract out from this gross amount some amount for vacancy. Concessions are like when if you've ever rented an apartment, they may be like, hey, we're gonna give you the first month for free, or we're gonna give you some amount for move-in, or that's what a concession is essentially. It's some amount that the landlord is gonna give you to attract you to rent your place there. Employee and model discount. So if you have an on-site manager, for example, you're probably going to give them like kind of free rent or discounted rent. So that's what they're including there because if you have 318 units, maybe you're renting one or two of them out to your staff for a discounted rate. So that's what that is. A bad debt expense. So that is basically for people that don't pay rent. So not only is there may be a physical occupancy, but you have to include the amounts that people are there occupying a unit and not paying you rent. So that's what that is. And then you have some positive amounts here. Okay, so utility reimbursement. So it looks like they're planning on charging probably for water, um, or some other kind of utility to the tenants. So you're going to see utilities as a line item here in the expenses, um, but they're going to recoup some of that because the tenants are going to pay for it. So it's likely water, most likely. That's probably the common one: water and sewage and trash. You may charge the tenants back for that. And then other income. So it's a substantial amount. You can see it's like 432,000. So that could be things like laundry. That could be things like a lot of landlords for these larger apartment buildings will sell like the internet. They'll kind of um, provide some internet package and collect some spread off of that, where they basically pay the internet company whatever 100,000, and they charge the tenants 500,000, and they collect that kind of difference. So then you get the total income here. This is what they expect to get, assuming all these different things. And then you have all your operating expenses. So this is property tax, not income tax. This is property tax, insurance, repairs and maintenance, general admin. So this is just like having like a leasing agent maybe on staff, uh, paying an accountant, just all the kind of administrative costs that are associated. A property manager. So this is going to be, they're going to hire someone to basically kind of manage the property. So there's a fee for that. Marketing, advertising. So to pay for, apartments.com or Google searches, there's some budget for that. Utilities. So again, this is likely for water, sewer, garbage. But again, they're collecting a lot of this back from the tenants. So it's this a large part of this is offset. Payroll. So this is going to be to pay for your maintenance people, to pay for your staff, whatever it is. There's going to be some payroll. Recurring capital expenditures. So they probably have some budget here just to reserve for like the roof, or you know uh, fixing the laundry room. There's probably some amount that they're just reserving for things that break and have to be replaced. And then franchise tax. So this is just like to have the entity, the legal entity that you're going to be using. There you have to pay the state. And this is Texas, so this is a franchise tax to the state of Texas. So you have this total expense. Then you're going to get your net operating income. Okay, so you can notice here that underneath the operating income, they're going to have how much they're paying their mortgage. Okay, so if you had just paid $60 million and just bought this thing without a mortgage, it's not going to change the operating income. Okay, the operating income is the income without considering anything about how you financed the purchase. Okay, it's just from the straight up operations of the uh, the property, and that this number is important because people are going to choose how they finance the purchase in different ways. Some people may only take out a loan of $20 million. Some people may take out a loan of 45 million. Some people may just buy the property all cash, and so that is not really relevant for how well the property operates. That's a financial decision. So the net operating income is just looking at the straight operations. It does not want to, it wants to remove any aspect of the financing decision. Um, what it also doesn't include, if you've taken accounting, is any non-cash item like depreciation. Okay, there's no depreciation really accounted for here. It's just the straight cash. It's how much you're collecting in rents and other income, and how much you're paying out for all the actual expenses. And so you can see here the net operating income, and then you have how much you're paying in debt service. Okay, so um, we can use this information to calculate the DSCR. So let's just take these numbers down. Okay, so I've copied the numbers down for the presentation here. So the first thing you notice is that the NOI is greater than the debt service. So that's good. That means that the property is generating enough profit after its expenses to pay the payments for the mortgage. Okay, so you want this NOI, the most, just the very basic kind of common sense analysis is that the NOI is greater than the debt service. Okay, so now we want to see kind of as a percentage and as a ratio how much margin of safety we have. So we're going to take the NOI and we're going to divide it by the debt service. And then what I can do is I can just highlight these cells to the right and then press Control R to kind of apply this formula. Excel is kind of smart enough to know how to do that. Another way, just to show you a little Excel trick, if you put the formula into this cell and then you take this corner and just drag it, it's also going to do the same thing. Okay, so we can see here that the DSCR is increasing over time because it looks like they're projecting probably rents are going to go up over these 3 years. And again, this is pro forma. This is not necessarily going to happen, but this is what their financial projections are assuming. So you can see that the DSCR is increasing. Now, remember, this is an amortizing loan, right? So there's some of this debt service that is paying off part of that $45 billion loan. There's some amortization. Okay. Let's just hypothetically assume this is an interest only loan. So that's going to change the debt service, right? Because now you no longer have any principal being paid down. And I'm just going to approximate this. We'd have to like do the actual calculations and like it's more complicated to see exactly how much debt service is principal. But let's just assume that 20% of each year was principal and 80% was interest. Okay, so I'm just going to take 80% of each of these. Okay, so now if the loan is interest only, then the payments drop, right? Because now you don't have to pay any principal. You're only paying the interest. So with the same amount of NOI, you can see the ratio goes up because now our debt service every year is less. We have the same amount of NOI, and so that ratio is going to just be boosted. And so in a previous video, I mentioned that by taking an interest-only loan, you can kind of boost the debt service coverage ratio. That's why here in this Excel sheet, I've kind of changed it to interest coverage ratio. Okay, so when you're calculating DSCR, uh, of course, you have the number for like you're gonna know what the mortgage payments are per month, and then you can kind of calculate that by 12 and get the per year. But really understanding what the terms of the mortgage are is going to be important in your analysis. If you want to be conservative, what you should do is if you have an interest-only loan, for calculating your DSCR, you should basically assume, hey, what if I had a market, like a common kind of market loan that is like because if I have to refinance the interest only loan, what is the most common type of mortgage I could get? And it's likely going to be a loan with an amortization. Okay, so what you should do as an underwriter if you're trying to invest in a deal is calculate the DSCR, not necessarily with the terms of the mortgage you're offering, especially if it's interest only, but maybe using a more conservative amortization schedule, something that's commonly available in the market. And so that will basically not, you won't fall into this trap of artificially inflating your DSCR and feeling like your deal is safer than it actually is. So hopefully, seeing the actual numbers from a real commercial real estate deal has been informative and insightful. We're gonna spend more time with this again in later module when we talk about commercial real estate in more depth, and watch professional investors kind of walk through their deals. You'll watch some videos on that. But for now, I think this is a really important uh, kind of segue into that because the financing is very important in terms of like how good a potential real estate deal is going to be. Some sponsors, people that are putting together these deals, may over leverage. They may have an LTV that's too high, and you can say that this deal, it could be argued the LTV is very high. and it's putting a lot of risk on the deal. So you may look at these numbers and be turned off by it. Okay, so understanding the financing is going to be very important, because really your potential loss as an investor, a big part of it is going to come from the loan. Okay, if the deal cannot pay off the loan, you could potentially lose all your money. That's the big risk, because the bank will just foreclose, take the property over, and you as the former owner are going to be out of luck. So again, understanding the risk from the loans, what you're getting into in terms of the financing, is going to be a critical part of being a real estate investor. And of course, if you ever become a mortgage lender or work in the kind of mortgage finance industry, knowing how to do all this stuff and make these calculations is going to be very important to your job.